Okay, if not PSU banks, what attracts you in the finance space in general? Is it private banks? Is it non-banks?
So, yeah, I mean, what I would do is I would look at, think about the Indian economy going from what it is today to becoming a global financial market, and think about all the things that you need to get from here to there. So the first thing you need is, very good rating agencies. So I would think about that sort of part of the capital markets. I would definitely look at the private banks, both small, mid, large, all of them. That is the easiest way to play the deepening of financial markets in India. I would look at also the NBFCs, but I think given Governor Rajan's pronouncement so far, it seems to me you're better off buying the private sector banks rather than the non-bank financial companies. Also, there is companies which will benefit from financial inclusion in the financial sector. These are smaller companies. They would be some of the ones I would look at.
All right, Rohit, let's take a break on that note. I have lots more questions for you on the public sector stocks that you hold, as well as on how you will approach the forthcoming season of divestment from the government. All that in a minute after this break. Welcome back to our special series, New Yorkers. Our guest today is Rohit Sah, the man in charge of small cap strategies at the fund TCW International. Rohit, let me look at your next set of stocks. You have PSUs like NALCO, EIL, BEML. Now, what's common? What kind of PSUs do you normally like?
So, again, let's go back to the crystal ball and look at India in the next 10 years. You have to develop, as I said, a global continental-sized economy, and I think that's the right way to think of India in the future. You have an economy which will look very similar to China and the US in the next 12 years. So you have to think in terms of what sectors have to grow a lot before you can get there, and which sectors are the ones where the Indian public sector is very well geared towards. So I would look at logistics as one. I would look at property as another one. I would look at any sector where the public sector company has a natural monopoly. So I would shy away from PSU banks. I would shy away from any manufacturing company that the Indian government owns. And that's the way I would go.
All right. The prime divestment candidates that are on the anvil are SAIL, ONGC and Coal India. Do you fancy any of these stocks?
I think the Indian government has a demonstrated track record of selling these assets cheap simply because nobody believes them anymore. So as a trade, these are good trades. Coal India is a good trade. I think, Steel Authority would be a good trade. I would hesitate to call them investments for the long term, though. So I would stick to companies in the public sector which are run very well, which are natural monopolies. And, I've already given you hints of which kind of sectors I would go into.
Rohit, do you like the oil PSUs? They have been actually quite a rage on expectations of fuel price decontrol and, in fact, lower subsidy burden.
Let me take ONGC as a very good example of what the problem might be for these companies. Most of ONGC's revenues and profits come from Bombay High. Bombay High is unfortunately a very old oil field, and it's literally dying under their feet. They're running just fast to just stand still. So in my criteria of companies which I buy, which are highly profitable, fast growing, and able to maintain the first two characteristics for a long time, I think ONGC does not fall into that bucket. None of these oil companies actually do. The only oil company in India which really does fall into that bucket that I like, which is high recycle ratios in oil companies, long-lived oil assets, and very fast payback periods on oil wells, is Can India. But unfortunately, Can India has serious corporate governance issues, and so is best left to the best to avoid Can India. So by default, I would say the oil sector in India, unfortunately, is not the right place to be. India is a very geologically interesting country in terms of oil and gas discoveries. You've already had the KG-D6 as a potential world-class asset, but I'm sure there'll be others coming up in the future. And what you want to do is you want to find those companies which are sitting on these kind of assets. And maybe it's Oil India maybe it's ONGC in the future, but only time will tell.
Actually, most India investors seem to like autos and auto ancillaries. And why not? They have done very well year to date. But anything that you like in this space?
I think India has some very good auto ancillary companies. I mean, Motherson Sumi and the Bharat Forge are the ones which immediately come to mind. I have not looked at others, but those two are the ones I would recommend.
Rohit, this year, liquidity has been very favorable for India. If the US Fed were to hike interest rates, do you see a liquidity drought?
First of all, I don't think the Fed is going to hike rates. I think the US economy is not as strong as everybody thinks. What we have is a growth scare, as some people call it, the scare that the US economy is growing faster than it is able to, and leading to inflation. I don't see any such possibility happening. So in that scenario, what you have is a dollar strength. But on the flip side, you also have China slowing down, so commodity prices are coming down. For India, the most important thing is not the Fed. I think it's oil prices, which are much more important, coal prices, and so on. So in that scenario, India does very well because if the Fed is not raising rates, the liquidity will continue to move into emerging markets, or at least to some emerging markets, and India is by far the best story out there. If the Fed were to raise rates, that would probably mean that the U.S. economy is doing a lot better than what I expect it to do. If that is the case, then there'll be, the U.S. will be importing a lot more goods from everywhere. That should be good for global growth, but only time will tell. Right now, I'm assuming that the Fed cannot raise rates, that although the liquidity into emerging markets will slow down, and the credit story in India is improving by the day. And as long as Prime Minister Modi can deliver on his economic reforms, I don't see any reason why the foreign money will go to a future continental-sized economy like India.
Yes, of course. Chinese slowdown and the commodities down cycle has been very good for India. But how long do you think both these trends will last?
That's a very good question, actually. The commodity market is right now being torn between two different factors. On the supply side, we have a real crisis developing. After 2016, when you look at the future copper supply, oil supply, natural gas supply, and all these various commodity sectors that are there, we have a real supply shortage coming up. What has helped us right now, and probably for the next few months, is China has slowed down a lot more than expected. So I think this run of good luck continues maybe till the end of next year at best. After that, if Mr. Modi hasn't fixed the Indian commodity supply situation, we have a real problem in India. So that is where I would leave it. I think the tailwind is behind India right now, probably dies out by the middle of next year and becomes a headwind by the end of next year.
And the evergreen big India stories are IT and pharma. You are underinvested, looks like, in both these areas. Anything you like particularly?
Yeah, so actually, I'm not a big fan of the information technology sector in India. I think it's actually a wrong word, a wrong classification. If you look at companies like Infosys and TCS, you do a simple calculation. You just calculate the ratio of their cash flow to employee and plot it backwards for the last several years. And it doesn't really matter which company you pick up. You get the same number, about $4,000 to $6,000 per employee per year, cash flow, profits, you name it. The problem is not the number. The problem is it's flat. It hasn't changed in the last several years. So in other words, if Infosys has to grow 20%, all you need to do is hire 20% more employees. That is not an IT company. That's a labor employment agency. So I am not very enthusiastic about the IT sector. Having said that, I have been wrong for the last 5 years. These have been some of the best performing stocks in India and globally, I would say. But there is a sell-by date for some stocks and some sectors. The pharma sector is one where there's a lot more hope. But again, you have to look at companies with new business models, not just the same old, formulation of the existing medicines. You have to start with somebody who can generate sales in a different way.
On that note, Rohit Sah, appreciate you taking time out for us. Thank you very much for joining us in our special series, New Yorkers.